The Vanguard FTSE 250 UCITS ETF. Is it any good? Well, in this video we're going to be covering the main areas in order to help you make the decision on whether or not it should be included in your portfolio. We're going to be using the research framework which I made specifically for these ETF review videos, covering the main areas such as the background of Vanguard, the past performance of the underlying index, which in this case is the FTSE 250, as well as the liquidity, the costs, the tracking error, and the risks and the opportunities involved. Finally, we're going to be scoring the ETF in 4 main areas, and that's just to make it a bit quicker and easier for you to compare against other ETFs. So, I'm sure you've heard of Vanguard as this such a well-known company, but what don't you know about Vanguard? Well, they were founded 45 years ago in 1975, and one thing that they do incredibly well is low-cost ETFs, ranging from everything such as the emerging markets to the S&P 500. They make themselves really hard to ignore with their super low expense ratios.
This particular ETF was created in September 2014 and tracks the FTSE 250. That is the next 250 medium-sized UK companies after the largest 100, that's the FTSE 100. These companies are not so big and they're not as global as those in the FTSE 100, and so they tend to be affected more so by national changes here in the UK. On average, the companies within the FTSE 100 rely on about 70% or so of their revenues coming from abroad, whereas those in the FTSE 250 rely on about 50% from abroad.
The index was reshuffled last Monday, just on the 22nd of June, and we saw some movement in the constituents in both the indexes. We saw companies such as EasyJet and Centrica, the owner of British Gas, move out of the FTSE 100 and down into the FTSE 250. Likewise, we saw some companies move up from the FTSE 250 into the 100, such as HomeServe and Kingfisher, the owner of the B&Q DIY stores. It's similar to football really, with the FTSE 100 being the Premier League and the FTSE 250 being the Championship.
The FTSE 250 index is weighted based on the constituents' market cap. That is the share price of each of the companies times how many shares are in issue. This means that not all of the companies in the index are invested into equally, with the 10 biggest constituents in the FTSE 250 holding about 11.49% of the funds in the ETF.
The performance of these companies then adds up to create the overall performance of the FTSE 250 index, which over the last 20 years has significantly outperformed that of the FTSE 100. Traditionally, investors would rely on the heavy dividends from the large companies in the FTSE 100, but during times of hardship such as in recessions, the FTSE 250 often performs better just because the companies are much smaller and much more nimble. They're able to react much more quickly. Since the year 2000, however, it's been hard to ignore that there's actually a growing chasm between the two indexes. Like I mentioned in one of my last videos about the iShares FTSE 100 ETF, ISF, the annualized return over a 20-year period for the FTSE 100 has been a meager 3.07%. I mean, that's barely above inflation.
We can see from the chart, however, that the FTSE 250 has significantly outperformed. Back in the year 2000, the two indexes were roughly the same price at about a ratio of 1:1. This is to be expected as the FTSE 100 contains the largest companies, but only 100 of them, whereas the FTSE 250 contains more than double the amount of companies, but the companies are a bit smaller. By the middle of 2007, just before the financial crisis, the FTSE 250 was trading at double the price of the FTSE 100, a ratio of 1:2. This gap carried on increasing to where we are now, with a ratio of 1:3 between the two indexes.
The 20-year annualized return for the FTSE 250 is just a little bit under 9%. This is incredibly strong if you bear in mind that during this time it's also gone through the dot-com bubble, the global financial crisis, and now coronavirus. So if you used to invest £10,000 every single year with an annualized return of 9%, then you'd be looking to be a millionaire in about 27 years. I mean, it's not bad really. This makes sense, right? The companies are so much smaller, so it's so much easier to grow. For the Vanguard ETF itself as well, the dividend yield is also very strong given the size of these companies, with a dividend yield of about 4.12% per year.
This is just 1.4 percentage points smaller than the ETF's big brother, VOOC, which tracks the FTSE 100.
So the dividend yield is pretty strong given the size of the companies, but I guess if you are a fixed income investor, then a slightly smaller dividend yield means that the FTSE 250 probably isn't the one for you. So the FTSE 250 has historically performed very strongly. But how does this translate into the actual performance of the ETF? That is, how well does the ETF track the index? Well, to see this, we can just overlay the two.
Here you can see the FTSE 250 in orange and the ETF in white. The time frame here is from 2014 when the ETF was created to today. And we can see that the ETF tracks the FTSE very tightly. In fact, if we add up the capital gains and the dividends of the ETF, then over the last 5 years, the ETF has only underperformed the FTSE 250 by about 0.78% per year, if we exclude the costs.
The cost of the ETF, like most Vanguard ETFs, is very competitive. The expense ratio is 0.1% per year. I found 7 ETFs which track the FTSE 250 and this one was the cheapest. It's quite remarkable really that you can track 250 companies for just 0.1% per year. It's even cheaper than the iShares ETF MIDD with an expense ratio of 0.4%. That's actually 4 times more expensive. The ETF is what we call a full replication ETF. That means it's expected to purchase all of the shares in the underlying index. And so it really is cheap considering you're tracking 250 mid-cap stocks for just 0.1% per year. It's also really easy to buy and sell the ETF with about £1.4 billion in assets. I guess that's why the ETF is so cheap, just because Vanguard can really make the most of these economies of scale. It's important for these ETFs to have a high asset value, as it just means that there's plenty of buyers and sellers in the market. Without this, it can mean that in times of hardship, you struggle to sell the ETF. And so a liquidity of about 1.4 billion just gives you the confidence that you can sell when you want to. But why would you want to sell the ETF when all I've been talking about is how good it is? Well, there is a couple of things to keep an eye on. For example, the FTSE 250 companies are much more reliant on the trade here in Britain. FTSE 100 companies are much more global, and so national fluctuations tend not to matter so much. For the FTSE 250 companies, changes in red tape and a weakening pound can cause serious headaches for them. Although a weakening pound is often good news for FTSE 100 companies, as it means that international buyers can purchase goods and services from Britain at a cheaper rate. For the FTSE 250, however, it's not so great, as they tend not to rely so much on international exports and instead just have to deal with the increasing costs from importing their raw materials.
The UK companies import the most from firstly the EU, then the USA and then China. This means that the FTSE 250 companies have increasing costs for their raw materials when the pound drops against the euro, the US dollar and the Chinese renminbi. And that is exactly what's been happening with all three. As anyone that's into forex trading would know, the pound has been consistently falling against all three currencies, making exports cheaper for the UK, which is great in one sense, but crucially for the FTSE 250 companies, making the imports for the raw materials more dear.
Now, I'm not saying that the FTSE 250 is facing complete financial ruin because of the falling pound, that is complete madness. What I am saying though is that if the costs carry on increasing for importing raw materials, then for FTSE 250 companies, it's like swimming against the tide all the time, and that can catch up in the long term. Now, it does mean that exports become cheaper, and so perhaps if the trend continues, then we'll see more of the FTSE 250 companies exporting abroad, something more akin to what a FTSE 100 company would do. But with the rise of nationalisation, I'm not so convinced myself, to be honest. This means that the index which the ETF tracks is facing some hardships going forward. But how safe is the ETF itself? Well, it's a UCITS ETF. That means that it's met certain standards which are in place to protect you as an individual investor from unsafe and unsuitable investment vehicles. If you don't know exactly what a UCITS ETF is, check out the video I made last week, which talks all about UCITS ETFs, as well as if the ETF provider or your broker goes bankrupt. I'll leave a link in the description. To score the ETF, we can break it down into the main areas which I covered in this video. Firstly, there's the past performance of the underlying index. Well, it performed very strongly, although it does lack the dividend yield just because the companies are a bit smaller. For this, it scores a 9 out of 10. The Vanguard FTSE 250 ETF tracks the FTSE 250, the underlying index, very closely. It has a tracking error of about 0.78% per year if you look at the last 5 years. This is really important as it means that if the tracking error is too large, then there's too much of a gap between the ETF and the benchmark. So if the benchmark, the underlying index, performs really strongly, there's going to be a misalignment with the ETF. If it's too large, then it means that actually you might be better off finding an ETF with a smaller tracking error, but a bigger expense ratio. It just depends on the specific example that you're looking at. The costs of this ETF, however, really are pretty good. I mean, there's no FTSE 250 ETF which compares with this in regards to the expense ratio at just 0.1%. I really can't say enough how good of an expense ratio this is, considering it's covering 250 companies. Some ETFs which are tracking the S&P 500 have a slightly lower expense ratio, but that's just because it's such large economies of scale. The net assets there are billions and billions of pounds. And so for this, it scores a 9 out of 10. Lastly, the FTSE 250 does face some headwind when it comes to the currency. It means that costs for importing the raw materials is increasing, and this can easily mean that the companies in the underlying index end up with runaway costs which they can't control. The rise of nationalisation means that it's quite unlikely that they're really going to benefit from the international exports of a lower pound. So overall, it scores a 6 out of 10 on the risks and the opportunities field. I hope you found this useful. I'm going to be leaving a link down below in the description to the research framework which I used for this ETF review video. I'm going to be using the same framework for all my ETF reviews going forward, and hopefully that's just going to make it a little bit easier to compare each ETF on a like-for-like basis using the same criteria. I hope you like it. By the way, if you've seen any of my other videos and you're thinking, what on earth is going on? Why is this guy so inconsistent? Well, all it is that I'm just starting out, and so I'm trying to figure out what works best for me. I've tried outside, inside, I've tried videos with lots of B-roll, and so I'm just trying to figure out what's the best way to tell a story and to make these videos less mundane. So bear with me, I'm still learning, but hopefully they're going to be getting better and better every single week.